So this topic 7, is an introduction to management accounting. Sometimes you'll hear it being referred to as managerial accounting. They're all much the same thing. Really what the focus is, and this is what we'll be looking at for the next 4 weeks after today, the change in focus from financial accounting, which is what we've done to date, to management accounting, is just moving from people outside the organization who want information about the organization to people inside the organization who want information about the organization. And if you think about that, and if you think about how easy it is for people inside the organization to access and the types of information they can access versus those outside, it's quite different. And that sort of relates into then the second question, which is the information needs of those internal users. Because we have a sense of what the information needs of those external users are. You may well have had to have answered it just in what you did in the last hour and a half. So the difference between management financial accounting is the user groups that the information is directed towards. So financial accounting, which is what we've just been doing, the focus is very much on the external user. Now, because, as seems to be the case, we have no whiteboard markers. If you imagine, and I said I'd never draw it again, and I'm not going to draw it again because I don't have any markers to do it, we have kind of that building being drawn up with smoke coming out of it, then all the way through to the financial statements. The reason we have financial statements is for people external to the business to get a sense of what the business is doing. That is a way, it is not the only way, but it is a way people get information about the business. Those people existing in possible shareholders, creditors, tax office, regulators, suppliers, customers. A lot of the focus with financial accounting, that's why we have financial statement analysis, is really on shareholders. Creditors often, I mean, they will look at financial statements, but often, especially the larger banks, if you're looking for a substantial sort of loan or if it's a public debt issue, potentially able to get additional information that you have to sort of put out there. Shareholders are very limited in terms of the amount of information they can get, especially sort of smaller shareholders. So the focus on external users, they want to know profitability of the company, they want to know kind of the riskiness of the business, and they use these larger sort of financial statements to work that out. Management accounting, the users are internal, they're within the business, which means their ability to get information. And I'm not talking about every single person within the business, because I could ask for information about the university's strategic things that are going on, and I can't get access to that because it's not just within my realm of kind of access. But management certainly can. They can get information about different parts of what the business is doing, and they can do it because they're within the business. I'm a shareholder in Woolworths. I can't go down to Woolworths head office and say, hey, look, I want to know what your strategic plans are and the nuts and bolts of everything that's going on, because they would just show me to the door. So internal users have greater access to information within the business. And it also means the types of information they're after and that they use is going to be different. Now, if you got these slides even from about 2 or 3 days ago, I think the headings were around the other way. These are the slides that are as now, and they're now properly round the right way. So if we look at management financial accounting, as we just talked about, the user groups are slightly different. Management are very much internal, financial accounting is very much external, which then leads into how this information is. Because that's what accounting is. It is about information. You don't necessarily, it's not about, even though it's got numbers, it's not about math. Yes, you've got to be able to add stuff up, but that's what calculators are for, that's what spreadsheets are for. It's about what this information tells you. It just happens to be numeric in nature. So with management information, they're looking for reporting which is specific to that particular organization's needs. Some of that's going to be financial, some of it's not going to be, there's going to be non-financial information. So if you think about a university, if we're organizing, and this happened, this is a little tiny bit that I'm involved with. When we're organizing classes and allocating people to classes, and I'm not as in students to classes, but staff to classes, we need to know how many classes we're running. To know how many classes we're running, we need to know how many students are enrolled. that is really important information, so we can allocate and work out who we have, where we have them, what rooms we need, all that sort of information. Those are important sort of decisions that need to be made. That's not going to be in any financial report that we make available external. It's not relevant to external users for it, but it is really important for us and how we do what we do. And you can imagine, think of businesses or companies or environments that you've been involved with, and think about what things could be important for their planning, for management to need to know. When are busy times, when they might need more people on shift, when are quiet times, what sort of things they need to do. Think about ordering, think about stock levels, it could be a whole variety of different things. These are really specific to the organization, which means the organization can just build them however they want. So that's important when we go through the next few weeks. We're going through just a general way of doing this stuff, but every organization will do it slightly differently because they'll do it to what fits what they need to do. Whereas when you look at financial statements, they're highly regulated. I can pick up a financial report from a South African company. I can pick up a report from a company based in Hong Kong. I can pick up a report from a company based in the EU. Okay, now the EU company, maybe I can't read it because it's in a language other than English, but in terms of the accounting, in terms of the format, in terms of how it's structured, I can understand that because they all use the same set of rules. I can't understand American companies as much because they use a different set of rules, but that's just American being American, doing things differently. But the reports are highly regulated. They have a set of rules. They have to be done in a certain way. How often they come out is regulated. The information that's in there and how it looks is regulated. It's pretty standard. And when you think of why, now I can't remember if it was in your paper because I didn't have a quick look at which question it was in. But as you were preparing, you're probably preparing for the characteristics of accounting. You should know what the qualitative characteristics of accounting information is. And an important one of those is comparability. Because financial information, a lot of it is is to make decisions between different courses of action. To do that, we need to be able to compare between different companies. To do that, you need pretty similar information. So financial accounting is fairly regulated in that way. With management accounting, and I was actually going through this and I was trying to predict how many of you guys were going to be in the course this session, because I needed to know roughly how many classes to have open and then predicting who we needed to have staff. So I was making predictions based on the information that was coming to hand about how many students we were going to have. It's very forward-looking information. I need to make a decision based on how many staff we need and how many classes to open, which classes to open, and I've got to do that before I actually know. So I'm making guesses on that. Now, anytime you're looking at forward-looking information, anytime you're looking at making decisions about the future, you're likely going to be wrong because you don't know. I'm pretty sure you don't. Actually, we can be pretty much guaranteed that you don't. None of us know the future perfectly. If we did, none of us would be here right now, because I'm pretty sure every one of us would have bought the winning lottery ticket or picked the right numbers or put money on the right horse or the money on the right stock, and we would have made a lot of money, and then we wouldn't be here. We don't know the future perfectly. It's with error. That's important when we start doing some of this stuff. We're making decisions about the future, so we need to sort of be making estimates about what we think it's going to be. Financial information or financial accounting is very much backwards looking. We've had a financial year happen. We do all the journal entries, and you've done some of them just in the last hour and a half or so. Do some journal entries, and at the end of the year, do some adjusting entries, do some closing entries, and that's your financial statements. It looks at what has happened. Management accounting is very much about what is going to happen. That's sort of the difference. We're looking at what has happened to what is going to happen. We're moving in that path now. We're looking at information to be making decisions in the future. So sort of information that we need to run businesses. So we need flexible and detailed information that will allow them to perform planning activities, operating activities, controlling activities, and we'll talk about what these are in a moment. So planning activities, short-term planning activities, or operational planning activities. I mean, these are, like, as I said, when organizing, trying to figure out how many classes to have open, how many staff to have on, that's what I was doing, like all through, what was it? Not really so much in February, but all through March, was trying to, like, looking at what the enrollments were at, because quite a few people enroll quite late nowadays, so it makes my ability to plan a little bit harder. So I had to look at what last year and how people enrolled over the period of time before class. So I've got a graph of, you know, how the enrollments changed, and I had to look at how, based on what happened last year, make a decision on what I expected to happen this year. Now, the thing which became really annoying from that is the behavior of the cohort this year was different to last year. People enrolled much later last year, so I thought there was going to be more people than there actually was, because you guys all enrolled a lot earlier, so which is a good thing, but I thought there'd be more people enrolling later. And that affects something like basically employee rostering. Cash needs at the top, not so much from my point of view, but if you think about a company which buys product to sell it, they'll buy it, they'll pay for it, it won't get sold immediately, they'll sell it, and then they may take time to recoup the money that to actually collect off their customers. So if you think about that, when cash goes out is before cash comes in. So they need to manage their cash flows, because you don't want to run out of cash. And that's really similar to how each of us, I actually have, depending on the topic, we may actually show this, I actually do this for myself, because if you think about how our cash flows work as individuals, that's pretty similar. I do 2 weeks of work and then I get paid. So my cash flows, every 2 weeks there's a spike coming in. But then I've got cash flows going out. I've got once a month, actually it happens in more than once a month because I've got more than one credit card. I'll have an amount going out because I've got credit card payments. I've got rent. I've got other things that are due. So I need to manage that cash flow to make sure that I don't end up in a situation where I've got to make a payment and I don't have enough cash for it. Because if my credit card bill is due a day before my pay comes in, I can't make the university pay me earlier. I just can't, they won't do that. So I need to make sure I know when these payments are going to happen and when I have outflows to make sure I'm not short. Or if it looks like I am going to be short, find someone I can borrow some money off, basically. So I need to be able to manage that. You know, if you've ever worked in retail or sort of any sort of thing where you've got sales quotas, you know, you'll know that you've got sort of pressure to make sales, to make quotas, to do these sort of things. So what are your sales? How are you going to reach them? You know, what are these targets? Inventory requirements. You may have this massive advertising campaign and marketing in your companies come up with something, but if you're not making enough stock, if you're not buying enough stock in to sell everything, it's kind of pointless. Unless you're Apple, who seem to sort of have this massive push towards the end of the year, towards Christmas, especially towards Christmas, say, you know, new iPhones or new iPods, and then don't have enough stock available because they want to kind of create this rush that, you know, you really need to have it. And then after Christmas, you can buy it really easily. So unless you're really sort of strapped for a present, you just wait till after Christmas has happened and buy it then. Long-term planning decisions. You know, where does the company want to be at? Do you want new equipment? Do you have to, you know, and we've just seen the Australian government do this. They've made, as of Tuesday, a big decision, or like they're increasing their decisions to say, we're going to, bless you, we're going to invest in capital expenditure. We're going to spend $8-9 billion extra they've allocated for, we're going to build a new inland railway. We're going to build a second airport in Sydney. We're going to do these other things. So, you know, big equipment investment. These are strategic decisions to make. You don't just build an airport for the sake of building an airport. You kind of need to think about this stuff. Where do you want to be longer term in terms of where the company goes, especially into new markets? Plant locations, again, sort of related to new equipment investment, but even location becomes important. And if you think about a lot of American companies, their decision as to where to locate their plants and manufacturing bases has probably changed somewhat since January 20. Before January 20, they were doing a lot more things offshore, maybe offshore or through Mexico or somewhere else. There is now an environmental change in terms of a new president, suggesting that maybe building these things in another country is not the way to go. So that's a long-term plan that they need to sort of build in, but then factors change around them and suddenly it's all different. Daily decisions. I'm going to ask, this is a question for you guys because we're going to be nice and quick on this. We'll get to the first bullet point last. That second bullet point, what price should be charged? When you have a physical product, what price, not in terms of like a dollar price, and I don't even care what the actual product is, just a physical product. How much should you charge for a physical product?
I would say a price that would cover the cost plus additional margin of profits.
Exactly, it's pretty simple. I mean, there's nothing tricky in that so far. If you want to make money, now you may not want to. You may want to run it as a loss leader, which is a different thing. But if you want to make profit on it, you want to sell that product for more than it cost you, which then leads to an interesting question. How much did it cost you? That's not always a straightforward thing. So we're going to look at over the next couple of weeks costing, because that actually becomes quite a complicated, it can become quite a complicated thing. So costing is an important aspect, and that's for a physical product. What about, actually 2 seconds. Do you need to rush off somewhere? Can I get you to hold on, because we don't have that much longer to go and I actually do want to have a chat to you. So can I get you to sit down for another 10 minutes, please? Thank you. So what price should be charged? It will cover costs. Now for a physical product, that has some complexities and we're going to get to those. But for a service-related product, for something where there is no physical thing that you're selling, if you're talking about consulting time, how much do you charge? How much do you charge for your time? That's not always an easy thing. Should we advertise? Well, hopefully if advertising leads us to a net benefit, then we should. If it doesn't, then we shouldn't. It depends on what you're trying to do with that. So advertising may be something that you do or you don't do. Should you charge? Should you have a special order? Now, what we mean by special order is if you're charging a certain price to the market in general, so you're selling product to all of you guys and I'm charging you $10 for it. If one of you come along and say, Shasham comes along and says, look, I'll buy 5,000 units, but I'm only going to pay $8, should you take it? And we're going to explore the decision, some of it quantitative, so we're actually looking at the dollars and cents behind it, some of it qualitative, because there may be good reasons, even if it makes you money in the short term, there may be good reasons not to do it. So we're going to look at these sort of decisions. And the last, and this is the last slide, as I said, it's a short one today. Using accounting information to motivate, monitor, and evaluate if employees are attaining company goal strategies. Now, every company, you may not be aware of your company's goals or missions or all the rest of it, but they all do have these things. They've got an overall goal that they want to achieve. That then rolls down through the levels through each individual person, and if it's aligned properly, it should all work out well. Not always done effectively. So you may well have performance measures tied to the things that you need to do. Some of those performance measures don't necessarily end up in good places. Now, if you think about the GFC a little bit, some of that stemmed from mortgages which were being sold to people that couldn't repay these things. But that's because the people who were selling the mortgages in the first place were incentivized just on the sales. As long as they were selling, that was what was important. Whether or not the mortgages got repaid, whether or not they blew up, they didn't care about that because they didn't carry the risk. As long as they made the sales, that's what was critical. So that leads to a situation where people are just pushing product where it may not necessarily be in the best interest of anybody. And you saw what happened after that. I've got performance measures tied to what I do. We get measured on a number of different ways, and they do come down in numerical measures primarily. Some of them are related to teaching, some of them are related to research. And that links to what the goal of the university wants to have happen. And if we don't meet those metrics, we get in a bit of trouble. If we do meet them, then it works out well for us. So that affects the things that we do and in a way controls what we focus on. And it's that idea of, what is measured counts. If it's not measured, then, at the end of the day, no one is actually sort of looking at it with all that much importance. So then that ties to sort of incentives and rewards. And probably we haven't put up there. So that's incentives and rewards are kind of like the carrot. But there's also the stick that comes along with that. If you're not meeting your sales targets, if you're not meeting your benchmarks, if you're not meeting your quotas, if you're not meeting your targets, you may well get fired. I'm not saying here, it takes a long time based on, you don't get fired from university all that quickly, but there are certainly things they can, do to make life a little bit less comfortable. But think about the jobs that you have or the jobs that you have had, and think about how you've been measured, because it happens pretty much everywhere. What is it that you do that's important to kind of how you get evaluated? So we will look at all these things over the next few weeks.